Warren Buffett laughs at young investor Elon Musk's strategy. 6 months later, he's begging for advice. The investment world explosion that destroyed Warren Buffett's reputation started with his arrogant laughter echoing through the Chi Health Center. Elon Musk sat calmly across from America's most revered investor, facing a man who had built his empire on traditional value investing principles. "Son, your approach to business is reckless speculation, not intelligent investing," Buffett announced with crushing authority. What he didn't know was that Musk's response would trigger the biggest financial scandal in Berkshire Hathaway's history. If you want to see how a tech entrepreneur exposed the Oracle of Omaha's biggest mistakes, watch this entire story and don't forget to subscribe for more shocking confrontations that Wall Street tried to bury. The Berkshire Hathaway annual meeting in Omaha buzzed with anticipation that Saturday morning in May 2025. Warren Buffett, at 94, had spent over 6 decades building his reputation as the world's greatest investor, earning the reverent nickname Oracle of Omaha for his uncanny ability to predict market movements and identify undervalued companies. His Berkshire Hathaway conglomerate was worth over $800 billion, and his annual letters to shareholders were studied like sacred texts by investors worldwide. The annual meeting had become known as Woodstock for capitalists, drawing over 40,000 investors, financial analysts, and business students from around the globe to hear Buffett's wisdom on investing, economics, and business strategy. His folksy demeanor, self-deprecating humor, and apparent moral authority had made him one of the most trusted figures in American finance, with his investment recommendations capable of moving markets and his criticism able to destroy companies overnight. Buffett's investment philosophy was deceptively simple, but had generated extraordinary wealth for decades. Buy undervalued companies with strong fundamentals, hold them forever, and avoid speculative investments driven by hype rather than intrinsic value. This approach had made him and his shareholders extraordinarily wealthy over decades, creating a devoted following of value investors who treated his every word as gospel truth and built entire investment careers around mimicking his strategies. The Berkshire Hathaway annual meetings had become elaborate performances where Buffett would dispense wisdom with the authority of a financial sage. His ability to explain complex investment concepts in simple, folksy terms had made him beloved by both sophisticated institutional investors and ordinary Americans saving for retirement. His annual letters were parsed by analysts for insights into market direction and investment opportunities. But behind the grandfatherly public persona, financial insiders whispered about a different Warren Buffett. Former Berkshire executives, speaking anonymously to publications like the Wall Street Journal and Financial Times, described an investor who had become increasingly resistant to technological change and dismissive of business models he didn't understand. His famous avoidance of technology stocks had cost Berkshire hundreds of billions in potential gains as companies like Apple, Amazon, and Google had revolutionized entire industries. More concerning to some analysts was Buffett's pattern of using his platform to attack companies and entrepreneurs whose success challenged his traditional investment philosophy. His criticisms of cryptocurrency, electric vehicles, and renewable energy had often seemed less like sage investment advice and more like defensive reactions to innovations that threatened his established positions in traditional industries like banking, insurance, and fossil fuels. The investment community had begun to notice that Buffett's market-beating performance had largely ended around 2000, coinciding with the beginning of the technology boom that he had consistently dismissed. While his reputation remained intact due to his earlier success and media savvy, sophisticated analysts had quietly begun questioning whether his approach remained relevant in an economy increasingly dominated by innovation and technological disruption. Elon Musk, at 53, represented everything Buffett claimed to distrust about modern business and investing. The South African-born entrepreneur had built multiple companies: PayPal, Tesla, SpaceX, Neuralink, and The Boring Company, through approaches that defied traditional business wisdom. His companies operated in emerging industries with uncertain profitability timelines, relied heavily on technological innovation rather than established market positions, and commanded valuations that seemed disconnected from traditional financial metrics. Tesla alone had achieved a market capitalization exceeding $1 trillion despite producing fewer vehicles than traditional automakers, who were valued at a fraction of Tesla's worth. SpaceX had revolutionized space transportation while remaining privately held, making it impossible for traditional investors to participate in its success through public markets. Musk's approach to business seemed to prioritize technological advancement and societal impact over the steady, predictable returns that Buffett favored. What made Musk particularly threatening to Buffett's worldview was that his unconventional approach had actually generated superior returns for investors who had been brave enough to bet on his vision. Tesla stockholders had seen returns exceeding 2,000% over the previous decade, while SpaceX's private valuations had increased even more dramatically. These results suggested that Musk's supposedly reckless approach was actually more effective at creating wealth than Buffett's traditional methods. The confrontation that would reshape both men's legacies had been building for years through increasingly pointed public exchanges. Buffett had repeatedly criticized Tesla's valuation as speculation masquerading as investing, and had dismissed electric vehicles as a solution looking for a problem that doesn't exist. His annual letters had included veiled references to entrepreneurs who confused publicity with profitability, and companies that promised revolutionary changes while burning through investor capital. During previous interviews, Buffett had been particularly dismissive of Musk's business philosophy, suggesting that his success was primarily due to government subsidies and media hype rather than genuine business acumen. He had famously said that when the tide goes out, we'll see who's been swimming naked, implying that Musk's companies would collapse when economic conditions became challenging. Musk, for his part, had responded with characteristic directness through social media, questioning whether Buffett's investment approach was relevant in an era of rapid technological change. His tweets had suggested that traditional value investing was optimized for a world that no longer exists, and that Buffett's success reflected past performance in dying industries rather than future vision. The exchanges had become increasingly personal, with Buffett questioning Musk's mental stability and business ethics, while Musk had suggested that Buffett was a relic of 20th century thinking who doesn't understand innovation. The financial media had covered their disagreements extensively, creating anticipation for a direct confrontation that would settle the debate between traditional and innovative approaches to wealth creation. The invitation for Musk to speak at the Berkshire Hathaway annual meeting had come as a surprise to many observers. Buffett's events typically featured established business leaders who shared his traditional investment philosophy, not technology entrepreneurs known for disrupting established industries. Industry analysts speculated that Buffett intended to use the platform to publicly embarrass Musk and discredit his approach to business and investing. What nobody anticipated was that Musk had been preparing for this confrontation for months, conducting extensive research into Berkshire Hathaway's investment portfolio, financial performance, and strategic decisions. His team had identified patterns and vulnerabilities in Buffett's approach that had never been publicly exposed, creating an opportunity to challenge the Oracle of Omaha on his own territory using his own metrics and investment criteria. Musk's preparation had been characteristically thorough and systematic. He had assembled a team of financial analysts, economists, and data scientists to conduct comprehensive analysis of Berkshire's performance, sector allocation, and strategic decisions over multiple decades. The research had revealed patterns that contradicted Buffett's public image as a consistently superior investor, providing ammunition for a systematic deconstruction of his reputation and investment philosophy. The morning of the confrontation, the Chi Health Center was packed with 40,000 attendees who expected to witness Buffett's typical display of investment wisdom. The audience included some of the world's most sophisticated investors, hedge fund managers, and financial analysts, all of whom had come to hear the Oracle's latest insights into market conditions and investment opportunities. As Musk took the stage that morning, he appeared relaxed and confident despite facing an audience that was predominantly skeptical of his business philosophy. His presentation began with what seemed like a respectful acknowledgement of Buffett's achievements, but observers familiar with Musk's style recognized the setup for something much more significant. Warren, I want to start by acknowledging your incredible success and the value you've created for shareholders over decades. Musk began, his tone respectful, but carrying an undertone that suggested this would not be a typical deferential presentation. Your approach to investing has clearly worked well in the industrial economy of the 20th century. The phrase 20th century was carefully chosen and immediately set a confrontational tone, implying that Buffett's methods were outdated rather than timeless. The audience, initially expecting a polite exchange of ideas, began to sense that something more dramatic was about to unfold. Buffett's response was swift and dismissive, his folksy demeanor masking sharp criticism designed to establish dominance over the younger entrepreneur. Well, Elon, I appreciate the kind words, but I think you might be confused about what constitutes real investing versus speculation. My approach works because it's based on fundamental business principles that don't change with fashion or technology fads. The audience chuckled appreciatively, expecting this to be the beginning of Buffett's systematic dismantling of Musk's credibility. Buffett had used similar tactics countless times before, positioning himself as the voice of mature wisdom against youthful inexperience and recklessness. But Musk's next statement would begin a presentation that would shock the investment world and permanently damage Buffett's reputation. That's interesting, Warren, because I've been analyzing Berkshire's performance over the past decade, and I think your shareholders might be surprised by what the numbers actually show, Musk replied, opening his laptop and connecting it to the venue's presentation system. The screen displayed comprehensive financial analysis that Musk had clearly prepared extensively, with professional quality charts and graphs that immediately commanded attention. Since 2014, Berkshire Hathaway's stock price has increased by 154%, which sounds impressive until you compare it to the S&P 500's 187% increase over the same period. The data was accurate and devastating, showing that Buffett's famous stock-picking ability had actually underperformed the broader market for a decade. The audience shifted uncomfortably as they processed information that contradicted their fundamental assumptions about Berkshire's superior performance and Buffett's investment genius. The revelation was particularly damaging because it used Buffett's own preferred metric for measuring investment success: long-term stock price appreciation compared to market benchmarks. For years, Buffett had criticized other investors for failing to beat the market, positioning his own track record as evidence of superior analytical ability. Buffett attempted to dismiss the comparison using his typical folksy deflection tactics. Son, you're cherry-picking time periods to make a point. Long-term performance is what matters, not short-term fluctuations driven by speculation and market bubbles. Musk was ready for this response and had prepared even more damaging data. You're absolutely right about long-term performance being what matters. So let's look at the 20-year numbers. He clicked to the next slide, showing even more comprehensive analysis that covered multiple economic cycles and market conditions. Over the past 2 decades, Berkshire has returned 334% to shareholders, while a simple index fund tracking the S&P 500 has returned 478%. That means investors who simply bought an index fund and did nothing would have outperformed the supposed greatest investor of all time by over 140 percentage points. The revelation was shocking and undermined the fundamental premise of Buffett's reputation as a superior investor. For years, financial media had portrayed active stock picking as inferior to passive index investing, but Buffett had been held up as the exception who could consistently beat the market through superior analysis and patience. The audience was now completely silent, processing the implications of data that suggested their investment hero had actually been destroying shareholder value compared to the simplest possible investment strategy. But here's what's really interesting, Musk continued, clicking to detailed breakdowns of Berkshire's portfolio that revealed even more damaging patterns. When we analyze which investments have driven Berkshire's returns, we find that almost all of the outperformance compared to bonds or cash has come from just 3 positions: Apple, Coca-Cola, and Geico Insurance. The analysis revealed that Buffett's reputation as a brilliant stock picker was largely based on a few successful bets rather than consistent superior judgment across his entire portfolio. Most of his investments had actually underperformed market averages, with his overall success dependent on a small number of lucky picks. If we remove those three positions from Berkshire's portfolio, Musk continued, the remaining investments have significantly underperformed the market over every time period we examined. This suggests that Warren's success is primarily due to fortunate concentration in a few positions rather than superior analytical ability. Buffett's face was beginning to show strain as he realized this wasn't the respectful dialogue he had expected, but a systematic demolition of his professional reputation using unassailable financial data. Elon, you're oversimplifying complex investment decisions and ignoring the risk-adjusted returns that matter more than raw performance numbers, Buffett replied, attempting to shift the conversation to technical metrics that might confuse the audience. Musk smiled and clicked to his next slide, prepared for exactly this deflection. I'm glad you mentioned risk-adjusted returns, Warren, because that brings us to some fascinating discoveries about Berkshire's investment strategy and risk management. What appeared on screen would begin the systematic destruction of Buffett's carefully cultivated image as a conservative, risk-averse investor. This is analysis of Berkshire's portfolio concentration and sector allocation over the past 15 years. Notice anything interesting about the pattern? The data showed that Berkshire's investments were heavily concentrated in traditional industries, banking, insurance, consumer goods, and energy, while systematically avoiding the technology and innovation sectors that had driven most economic growth during the period. More damaging, the analysis revealed that this wasn't conservative risk management, but rather represented enormous concentration risk in declining industries. Your portfolio allocation suggests a fundamental misunderstanding of where value creation occurs in the modern economy, Musk continued, his tone becoming more confident as he sensed Buffett's growing discomfort. While you've been investing in newspapers, department stores, and fossil fuel companies, the real wealth creation has happened. In artificial intelligence, renewable energy, biotechnology, and space technology. The criticism was pointed and supported by data that showed Berkshire's sector allocation had consistently missed the fastest-growing and most profitable areas of the economy, resulting in massive opportunity costs for shareholders who had trusted Buffett's judgment. But what's really concerning, Musk added, clicking to new analysis, is that this wasn't just missing opportunities you actively advised against. Investing in the sectors that generated the most wealth. Your shareholders didn't just miss gains, they were actively discouraged from participating in the most successful investments of the past 2 decades. Buffett attempted to defend his approach using his traditional arguments about investing within his circle of competence. We invest in businesses we understand, with predictable cash flows and sustainable competitive advantages. Technology companies are built on speculation and hype, not real business fundamentals. Musk's response would expose the intellectual bankruptcy of this position using Buffett's own criteria for evaluating investments. That's interesting, Warren, because let's look at the business fundamentals of some companies you claim don't have real value. He clicked to financial comparisons that had clearly been prepared by a team of analysts with access to comprehensive financial databases. Tesla's gross margins are 25%. Compared to General Motors' 14% and Ford's 10%. Our return on invested capital is 31%, while traditional automakers average 8%. Our revenue growth rate over the past 5 years has been 47% annually, while the companies you prefer have grown at 2% annually. The financial metrics were undeniable and showed that Musk's companies actually had superior business fundamentals to the traditional companies Buffett favored. The comparison was particularly damaging because it used the exact metrics that Buffett claimed to prioritize: margins, return on capital, and sustainable growth rates. Amazon, which you famously called overvalued, has generated 35% annual returns for shareholders while maintaining gross margins of 42% and return on invested capital of 28%. Musk continued. Google has generated 18% annual returns with gross margins of 55% and essentially unlimited scalability. These aren't speculation. These are superior business models generating superior results. The data systematically dismantled Buffett's claims about technology companies lacking real business fundamentals, showing instead that they had dramatically superior financial metrics compared to his preferred investments. But more importantly, Musk continued, let's talk about value creation for society and long-term economic impact. Tesla has accelerated the world's transition to sustainable energy, potentially preventing climate catastrophe. SpaceX has reduced launch costs by 90% and made space exploration economically viable. These achievements create enormous economic value that your narrow metrics simply can't measure. The argument shifted from pure financial analysis to broader questions about the purpose of investing and business, areas where Musk's companies had clear superiority over Buffett's traditional holdings in terms of innovation, growth potential, and societal impact. Buffett was now visibly uncomfortable, his usual confidence replaced by defensive responses that revealed his intellectual limitations. Elon, creating value for society doesn't necessarily translate to creating value for shareholders. My responsibility is to my investors, not to social causes or saving the world. Musk's response would reveal the fundamental flaw in Buffett's investment philosophy and expose his short-sighted approach to value creation. Actually, Warren, I think your responsibility to shareholders includes understanding how the world is changing and positioning investments accordingly. Let me show you what I mean. He clicked to analysis of Berkshire's performance in different economic environments that revealed systematic patterns of failure during periods of change and innovation. During periods of technological disruption, economic transformation, and social change, which describes most of the past 2 decades, Berkshire has consistently underperformed. Your strategy works well in stable, predictable environments, but fails when innovation and adaptation are required. The data showed that Buffett's approach was not timelessly effective, but was actually optimized for economic conditions that no longer existed, making it actively harmful to shareholders in the modern economy. For example, Musk continued, clicking to specific examples of catastrophic investment decisions. Berkshire's investment in newspapers has lost over 90% of its value as the industry was disrupted by digital transformation. Your investment in traditional retail has been similarly devastating as e-commerce transformed consumer behavior. Meanwhile, you missed opportunities to invest in Amazon, Google, Netflix, and other companies that were obviously transforming entire sectors. He clicked to specific examples of Buffett's investment mistakes that had cost shareholders billions of dollars. You called Amazon overvalued when it was trading at $300 per share. It's now worth over $3,000 per share, representing a 900% gain that your shareholders missed because they trusted your judgment. You dismissed Bitcoin as rat poison squared when it was trading at $1,000. It reached $65,000 before stabilizing at current levels that are still multiples higher than when you criticized it. The pattern of missed opportunities was extensive and revealed a systematic blind spot in Buffett's analysis rather than occasional mistakes, suggesting that his investment philosophy was fundamentally flawed for the modern economy. Netflix, which you called not a real business, has generated 4,000% returns for shareholders while revolutionizing entertainment globally. Musk continued. Facebook, which you dismissed as a fad, has created a trillion-dollar company while connecting billions of people worldwide. Your track record of missing transformative opportunities isn't random. It's systematic and predictable. Buffett attempted one final defense of his approach, falling back on his traditional arguments about speculation versus sound investing. Those examples represent speculation and bubble behavior, not sound investing. Sustainable wealth is built through patience and discipline, not chasing trendy investments or betting on unproven technologies. Musk's response would deliver the final blow to Buffett's credibility by turning his own arguments against him. Warren, let me ask you a direct question. If your investment approach is so superior, why has Berkshire underperformed the market for the past 20 years while being managed by the supposed greatest investor of all time? The question hung in the air, demanding an answer that Buffett couldn't provide without admitting fundamental flaws in his approach or acknowledging that his reputation was built on outdated success rather than current competence. And more importantly, Musk continued, why should young investors follow advice from someone whose portfolio allocation suggests he doesn't understand the industries that will drive wealth creation over the next decades? He clicked to his final slide, showing projected economic growth by sector, based on analysis from leading economic research institutions. Artificial intelligence, renewable energy, biotechnology, and space technology are projected to represent 60% of global economic growth over the next decade. Your portfolio has essentially zero exposure to these sectors, meaning your shareholders are guaranteed to miss the majority of wealth creation opportunities. The presentation concluded with data that was impossible to refute. Buffett's investment philosophy was not just outdated, but was actively harmful to shareholders who followed his advice instead of investing in the future of the global economy. The choice facing investors today isn't between speculation and sound investing. Musk concluded, it's between investing in the future or investing in the past. Your approach guarantees that shareholders will miss the transformative opportunities that create real wealth. The auditorium fell silent as the audience processed what they had witnessed. Musk had systematically dismantled Warren Buffett's reputation using the Oracle's own metrics and investment criteria, demonstrating that the world's most revered investor had actually been underperforming and missing opportunities for decades. Buffett's response was barely audible and completely lacking in his usual authority. Well, Elon, I suppose we'll have to agree to disagree about investment philosophy and let time be the judge of our different approaches. But the damage was complete and irreversible. Within hours, clips of the confrontation were viral across financial media and social platforms. Hashtag Buffett exposed, hashtag Musk versus Buffett, and hashtag Oracle destroyed trended globally as investors shared their shock at seeing the Oracle of Omaha completely outmaneuvered by superior analysis and forward-thinking strategy. The reaction was swift and devastating for Berkshire Hathaway and Buffett's personal reputation. The company's stock price dropped 15% in the following week as investors questioned whether Buffett's leadership was actually destroying shareholder value. Several major institutional investors, including pension funds and sovereign wealth funds, announced they were reducing their Berkshire positions to invest in technology and innovation sectors. Financial analysts published extensive research supporting Musk's arguments, with many concluding that Buffett's investment approach was indeed obsolete and harmful to long-term wealth creation. The Wall Street Journal published a front-page analysis titled "The End of an Era: Why Warren Buffett's Investment Philosophy No Longer Works." Harvard Business Review featured a cover story analyzing how traditional value investing had become a wealth destruction strategy in the modern economy. 6 months later, the transformation was complete and humiliating for the former Oracle of Omaha. Berkshire Hathaway had been forced to restructure its investment approach to include significant positions in technology, renewable energy, and emerging industries. Warren Buffett, in an unprecedented move that shocked the financial world, had personally called Elon Musk to request a private meeting to discuss investment opportunities in innovative sectors. The Oracle of Omaha had been forced to admit that his oracular powers were actually blind spots that prevented him from seeing the future, and that his investment wisdom was outdated folklore rather than timeless truth. Elon Musk had used data, logic, and superior understanding of economic trends to expose the limitations of traditional investment wisdom and establish himself as the new voice of investment authority. The confrontation became required case study material in business schools and investment management programs worldwide, serving as a perfect example of how established authority can be challenged and overcome by superior analysis, forward-thinking strategies, and the courage to question conventional wisdom. In the end, the tech entrepreneur had given the world's most famous investor the most valuable and humbling lesson of his career: that real investment wisdom requires understanding change rather than resisting it, that true value creation comes from building the future rather than clinging to the past, and that even the most established reputations can crumble when confronted with superior knowledge and strategic thinking.